Okay, dear colleagues, it's time to start. So I'm Rami Peltola from the UNECE, and I'd like to welcome you to the second day of the meeting of the group of experts on national accounts. Today, our focus will be on digitalization in the context of the SNA. As many of you may know, the current SNA uses the word digital twice. In chapter 15, in the context of the measurement of changes in quality over time. There, the SNA takes as an example the introduction of a digital camera to replace a non-digital one. I'm sure that we will find the word digital a few more times in the updated SNA. But I will leave further elaboration to our session organizers. So today, our session chair is Eric Strassner, Associate Director of National Economic Accounts in US Bureau of Economic Analysis, and he's also the co-chair of the task team on digitalization. And our moderator today is John Verinder, Head of Unit of National Accounts Methodology in Eurostat. But before I give the floor to today's session organizers, I'd like to remind you of a few things. The meeting platform we use allows interpretation, but at the same time limits the slots for speakers to 6 only. If you wish to listen to the interpretation, select the right channel in the upper left corner of the platform. To take the floor, you need to click on the green Raise My Hand button, just above the participants list. You may enable your microphone and camera only when given the streaming rights. You can find the latest timetable and other documentation at the meeting website. My colleague Marlen Chikitekov will post the link in the chat. If any technical problems occur during the session, you may contact Marlen in the private chat by clicking on the gray arrow next to his name in the participants list, or you may contact Interprefy Remote Help by clicking on the blue icon with the exclamation mark in the bottom right corner. You may also send an email to national.accounts@un.org if you face any issues. And that's it. Over to you, Eric. Looking forward to digitizing the SNA.
Well, thank you very much, Rami, and good day, everyone. I'd like to begin by thanking John Verinder for as moderator of this session, and also to John and Nicola Mazzarelli of Eurostat for co-organizing this session on digitalization today. There are several prominent topics on the SNA research agenda which we will hear about today. We've made quite a bit of progress over the past couple of years, but no doubt there is more work to do. What we'll hear about include the latest thinking on how to record and measure data, as well as free products in the accounts. In addition, we will hear from our colleagues about latest work to provide practical measurement of digital SUTs in high priority indicators, on measurement of own account data as an asset, and on digital trade. We will then conclude today's session with an overview of the digitalization task team's efforts on other priorities on the digitalization agenda. So again, as Rami laid out, what we realize is there's quite a bit of work we have to do here to update the SNA to really make digitalization more visible within the frameworks and within our accounts. And so we look forward to continuing this progress today and through other settings moving forward. Before we begin, I'd like to remind the presenter to time and to speak clearly and not too fast to ensure smooth interpretation. Each presenter will have 15 minutes, and as needed, I will give you a prompt to let you know that we're running short on time. Participants listening to the presentations can write their comments and questions in the chat during the presentation. John will follow the chat and summarize the comments and questions received. If time allows, John will also give the floor to some delegates. If you wish to speak, click the raise my hand button. We have 3 presentations before the break, and so I'd like to introduce the contributors to this session. The first is Ziad Ghanem, Director of Industry Accounts Division at Statistics Canada. Unfortunately, we've had some challenges with his audio, and so I will do my best to provide that presentation. Second, we'll hear from Dylan Rasir, Chief of National Accounts Research and Analysis at the U.S. Bureau of Economic Analysis. And then we will hear from John Mitchell, an analyst at the OECD and one of the leads on digitalization. Okay, so this first presentation by Ziad is on measuring the digital economy, the Canadian Digital Supply and Use Tables Framework. And so I will do my best on this one. Rami, if we can pull up the screen share when you get a chance.
Coming. Yes.
Yes, excellent. So I see that you see it, Rami? Very good. Okay, so let's get started. To the next slide, please. Okay, we know from our Canadian colleagues, they've done quite a bit of work over the last several years to develop digital supply and use tables and high priority indicators. And so today, the talk will describe data sources, measurement methods, classification, and there'll be a focus on digitally ordered products, digitally delivered products, results, and a look toward the way forward. Next slide, please. Next slide. Okay, so for the Canadian Digital Supply and Use Tables, the reference years for the project so far are 2017 through 2019, published this past April. These accounts are for the aggregate Canadian level, but there are some provincial data on GDP and jobs based on the industry dimension. It's an experimental product based on currently available source data, and there's been some refinements of the methodology, clarifying some data gaps, feedback from users, as well as efforts to develop better international comparisons. There are also revisions with this project due to the benchmarking of the 2018-2019 supply use tables. And the methodology incorporates an advanced Canadian SUT, where nominal output and GDP by industry are not fully integrated with other published industry volume measures. Some of the digital economy elements may differ from other measures in the Stats Canada statistics. Next slide, please. So the focus here is to count according to the guidance from the OECD framework for digital economy indicators. The advantage is international comparability. There's an effort here to expand the current detail in SUTs. The current industry and product classifications in many countries do not necessarily show the relevant details or aggregates for the digital economy. And of course, this is very much the focus to bring that visibility. And to produce this account, it requires a breakdown of information in the SUTs. Additional information brought in accounts include many of these efforts to look beyond the current SUT, that is to value data and free digital services. Data continues independently of the digital SUTs. And so Ziad also acknowledges there's many risks around this project, but nevertheless, just like we've seen in other settings, we can't let those challenges be a roadblock to progress. Next slide, please. Okay, for the framework, we have digital industries, new statistical units on digital-only firms, digital products and products significantly affected by digitalization, and digitally ordered and digitally delivered products. Next slide, please. On to data sources, next slide. So the use of survey data in this account includes the annual business surveys, e-commerce modules, the annual survey of international transactions and commercial services. This is to get at the digital delivery mode. So this is a digital delivery module. Large proportion of services exports are digitally delivered. It also makes use of household data from the Canadian Internet Use Survey for 2018 and business surveys on the Survey of Digital Technology and Internet Use 2019. Next slide, please. There's also quite a bit of administrative data brought in, corporate income tax data from internet sales forms. This includes information on the values, but also proportion of online sales. Income tax data for unincorporated units. These units are dependent on intermediary platforms. Also brings in the value-added tax information, including remittances by non-resident firms and the customs merchandise imports. I think this means for low-value courier shipments as well, where there's been exponential growth and is assumed to be e-commerce related. Next slide, please. On to measurement methods. Next slide, please. The general approach to estimation is an allocation, not a recompilation approach. Incorporate information where available and use simplifying assumptions for the remainder. In general, output information is available to split inputs based on outputs for digital units and proportionally allocate outputs to uses for digitally ordered. Next slide, please. Here, there's a slide showing the digital industry detail. Digitally enabling industries are largely the ICT industries. It's the largest component, mostly a simple mapping from current SUT industries with some minor industry splits. Digital intermediary platforms charging a fee. This is mainly in taxi, delivery, and short-term accommodations, but also some unexpected industries, for example, restaurants, which are only takeout. This relies on micro records and tax data. Firms dependent on intermediary platforms. This is the incorporated and unincorporated units, mostly based on tax data. Data and advertising-driven digital platforms. Small values in Canada, mostly advertising with very little data-driven platforms. E-tailers, which are the online retailers and wholesalers, mostly available from survey data, but there could be some misclassifications. Digital-only firms providing finance and insurance services. There's difficulties here in distinguishing purely digital units, and Stats Canada is working on a fintech framework that may provide a useful path forward. And then other producers only operating digitally, which include gambling, dating sites, and so forth. Next slide, please. Okay, to focus on intermediary platforms is to split each impacted industry outputs and inputs into traditional units, intermediary platforms for residents, incorporated units dependent on the resident platform, the non-resident platform, and unincorporated units dependent on resident platforms and non-resident platforms. In the product dimension, there's a focus to delineate detail on platform fees paid by producers and often consumers as well, and payments to non-resident platforms based on output by dependent units. Next slide, please. For digital industries, the focus is on splitting main industry outputs. In general, inputs and gross value added components are derived based on average industry coefficients. Refining production functions is part of future work on this project. Next slide, please. Okay, on to classification of products. Next slide, please. So focusing on classification of digital products and significantly impacted areas, mostly a reordering based on current classifications. There's a focus here on cloud computing, allocations to split output of software and data processing and hosting into cloud versus non-cloud based on review of annual reports of largest firms. Classification, we've seen some of this type of work happen by other national statistical offices as well. I'll just note that. Digital intermediary services based on the approach explained for allocating digital industry. On to digitally ordered products. Next slide, please. Okay, so to orient here, the Canadian digital SUTs, goods digitally ordered through domestic distributors are shown as digitally ordered by consumers, and their outputs and imports ordered through distributors. As distinct from the OECD framework category, A4 is added to identify these products. So you see here, there's a bit of an expansion of what we've seen through the guidance coming out of the advisory group at the OECD. And so the idea here is that much simpler to measure the distribution margin only, but it's also analytically limiting. Next slide, please. Okay, excluding domestic retailers, output based on e-commerce modules from annual business surveys. The imports are based on customs imports for large non-resident e-commerce sites and a proportion of small valued courier shipments. So here, there's a proportional allocation of outputs and imports to uses. Outputs are apportioned based on class of customer modules from annual business survey data. And I think we've seen this also, I'll just note, in some other projects that we've heard about in the past. Next slide, please. For domestic retailers, margin outputs based on e-commerce modules from business surveys. Here, this allocation of margin output to uses based on the valuation tables. Outputs are apportioned based on class of customer modules from business surveys. From margin uses derive consumption expenditures based on survey sales to margin ratios, and consumption expenditures are allocated to imports and domestic production where deemed to be missing. Next slide, please. Okay, there's challenges here in terms of digitally ordered. The survey modules on e-commerce sales or micro records of online units do not provide information on use categories. Next slide, please. On to digitally delivered products. Next slide, please. There's no data sources except for from the module on the survey of commercial services exports. So based on the characteristics of the products in the SUTs, there are some splits that are made for books and newspapers. Missing education, which is important in 2020, government services. Next slide, please. On to the results. Next slide, please. Okay, so here we've got a look at some of the data that was published back in April. Digital industries accounted for 5%, or more than $205 billion of total output. Digitally ordered products represented 6.8%, or $336 billion of total supply. And digitally delivered services represented 2.3%, or $116 billion of total supply. Most digitally ordered products, 71%, were sourced directly from the supplier, whereas 27% were purchased through domestic retailers and wholesalers. Approximately 7.2% of imports, or $52 billion, were digitally ordered, which slightly exceeded the share of digitally ordered from domestic producers, which was 6.8%. The share of digitally delivered products in domestic production, 2.4%, was higher than its share in imports, which was 1.8%. Next slide, please. Nope, we're catching up. Okay, onto the use table. Households accounted for approximately 30% of digitally ordered products. The digital industries had the highest proportion of digitally ordered purchases at 14%. For other industries, households and exports, this proportion hovered around 8%. And digitally delivered covered 2.3%, or 17 billion of total exports. And I think we'll see the circles here. Next slide. Yep. Great. Okay, looking at industry shares of total gross value added for 2019, we can see in the chart where the digital economy is situated relative to traditional industry classifications. At 5.5%, or 118 billion of Canadian GDP in 2019, the digital economy ranked slightly below mining, quarrying, and oil and gas extraction, which was 119 billion. And so a fairly considerable size digital economy in Canada, as we see here in the chart. Next slide, please. Okay, on to digital industry GDP and jobs for this period. The contribution of the digital economy to total GDP trended up from 5.2% or 103 billion in 2017 to 5.4% or 111 billion in 2018 and 5.5% in 2019, so a rising share. The sector and overall jobs also followed a similar trend, increasing from 4.3% of total jobs in 2017 to 4.8% or 1,000 jobs in 2019. Digitally enabling industries, traditionally referred to as information and communication technology, ICT, dominated production in the digital industries. The contribution from the contribution to GDP, digitally enabling industries contributed 88.5% of the GDP in the digital sector, and a lesser share, 76.7% of jobs in 2019. And this was mainly driven by the telecommunications industry. Next slide, please. For the way forward, Canada's focus will be on differentiating industries, the digital versus non-digital, refining the ordered by use categories. There's going to be a focus to the focus on online activity is an area of ongoing research to expand the frames into the future, likely due to increases in overall activity online. There's a focus on the business sector market activities, and there might be missing measures of digitalization in public administration, education, and health. And there's work to do on the conceptual measurement framework and data sources. And then also a key focus is extending the time series back in time. This may be difficult due to the lack of source data and smaller diminishing values in some areas. And so this is under experimentation. Okay, I think that concludes the presentation. And here you have the references from the Canadian work. And I'd like to thank Ziad for this presentation. Next slide. Okay, great. So with that first presentation completed, I'd like to now turn to Dylan Rasier to hear from him on free products, a guidance note, including work to explain how the treatment's coming together for the core and for a satellite account framework. Dylan, the floor is yours.
Okay, thanks, Eric. I'm pulling up my screen now to share it. And can you see the screen okay?
Yes.
Okay, great. And I think Eric deserves a virtual round of applause for doing a great job presenting somebody else's work. I hope he just doesn't put me to shame for delivering my own. So this presentation is going to cover an update on the digitalization task team's work on the treatment of free digital products in national accounts. The work is collaborative, and I owe thanks to Richard Hayes and Cleona Taylor from ONS, as well as Jennifer Rabarski, Marshall Reinsdorf, Peter Van de Ven, and John Mitchell for recent discussions. The work is still in progress, and some of what we're presenting today is still subject to consultation by the task team. So any errors are my own, and we also welcome your feedback at this early stage. So this is just some background information in the form of a timeline. So the work on free digital products started with an issue paper on data, free assets, and free services that was shared with the task team for comments in March of 2020. And then in June, Eurostat, as the Secretariat, drafted a guidance note on recording and valuation of data, and also drafted a proposal for a way forward on free assets and free services. Then in November of last year, a subgroup of the task team got together to discuss two streams of work on free products. And we agreed on two separate guidance notes. One guidance note would provide a clarification on the current SNA treatment of free products, and it would be led by Jennifer Rybarski and Marshall Reinsdorf. And another note would propose an SNA satellite account for the treatment of free digital products, and it would be led by Richard Hayes and myself. It's important to note that there was general sentiment that neither guidance note on free products would result in any changes to the SNA central framework. Then in April of 2021, the OECD issued a paper that included more considerations for treatment of data as an asset, which is also provoking additional considerations for free digital products. So from here, we'll briefly discuss the intersection of free digital products and data as an asset, and then we'll overview the intentions of each of the two guidance notes on free products and walk through some T accounts to outline options for a satellite account on free digital products. John Mitchell is going to be discussing the OECD paper, but I want to mention a few features of it. The paper and the discourse around free products generally focus on digital platforms, such as social media platforms, and digital apps like fitness and entertainment apps. The OECD paper distinguishes recording and processing costs from OP procurement costs. OPs stand for observable phenomena, which are exactly what they sound like. They're bits and pieces of observations that exist prior to any efforts made to produce a data asset. Recording and processing costs include the usual costs incurred for recording, organizing, storing, and processing OPs to generate information content. The central theme of the OECD paper is to highlight the value of OPs and how that value should be reflected in the accounts as either a produced component in the data asset or a non-produced component somewhere else in the accounts. And they identify three ways of accessing OPs, and the one that we're focusing on today is in exchange for free services. Marshall Reinsdorf and Jennifer Rybarski have written a draft guidance note on the current treatment of free digital products in the SNA. They point out that both platforms and non-platform market producers often bundle items that are free or priced below cost with marked up items to maximize profits. And the bundle as a whole generates revenue that is commensurate with the amount of production taking place. They explain that digital platforms play an intermediary role by supplying free products that facilitate the interaction of two or more parties. There's a subsidized side, which we're going to illustrate as households in our examples. And there's a funder side, which we're going to illustrate as an advertiser sector. The funder pays a markup that covers the cost of the free products and then recovers that cost in the advertised product that it sells. The subsidized side indirectly pays for the use of the free products with the purchase of the advertised product. Marshall's and Jennifer's salient point is that the ubiquity of bundled digital and non-digital products should have a consistent treatment in the SNA Central Framework, and there should be no separate treatment for free digital products. So we're going to turn next to an illustration of the current SNA treatment of free products using an example sequence of accounts, which we'll then build on to demonstrate some satellite options. Here we're showing the baseline scenario for the current central framework of the SNA. So the numbers will remain pretty much the same throughout the examples, except when we add the data asset. There are three sectors, which are households, an intermediary sector, such as Facebook, and an advertiser. So think of a face mask producer with ads on Facebook. The last column shows the total economy, and we're only showing accounts with relevant activity to keep the visuals manageable. The transactions include the development of platform software by the intermediary at a cost of $150, which is used for own account gross fixed capital formation. There's also an entry for the development of a database valued at 60 by the intermediary, which should be thought of as a database that's currently within scope of the S&A boundaries. These are all highlighted in red. Next are the advertising services produced by the intermediary sector and sold to the advertiser sector at 275. Keep in mind that the 275 includes the value of the advertising services and the value of the free products. In other words, the advertising services and the free products are bundled, but that's not visible in the current S&A treatment. Then finally, for the current S&A treatment, the advertised products are sold by the advertiser to the household sector for 300, which is shown in red here. Again, the 300 includes the value of the free products, which is invisible. Overall, GDP for the economy is 510, shown in blue, and net lending and borrowing is 0, also shown in blue in the bottom right, because there are no external transactions. And we're showing those balancing items in blue. So we're turning now to the options for an S&A satellite account on free digital products. And the primary objective that we've considered so far is to make the role of the household more visible. The intersection of free digital products and data as an asset is a key consideration for a satellite account. And so we think that some consensus needs to come together on data as an asset before we settle on an S&A satellite account for free products. We start with the inclusion of the recording and processing costs as suggested by the OECD. And then we consider an option for recording procurement costs for OPs, access to exchange for free products, which we include as gross fixed capital formation. We've attempted to outline the scope of free digital products, and the key factors are digital content provided without monetary charge in exchange for access to household observable phenomena. And those OPs can then be transformed into a data asset for production purposes. Cleona Taylor and Richard Hayes gave a nice presentation last week at the ESCO conference in which they outlined a typology for free digital products that includes advertising supported products and also includes the freemium model in products that are truly free, such as personal web pages. The options we're presenting today fall under the advertising supported class of products. We've considered the household as both a final consumer of free products and an intermediate consumer in the production of OPs, but today we're going to only show the former option as a final consumer. For the baseline satellite account, we suggest imputing the value of the free products using a sum of costs and then recording those separately from the value of the advertising services, which could be calculated as a residual.
It looks like we might have lost Dylan.
It seems so. Sasha, could you try to reconnect Dylan?
Yeah, but he's not online.
Let's give him a moment to try to reconnect. If we can't get him reconnected, we might move to John and then return to Dylan. Thanks, John.
He's not yet connected.
I'd say let's give him another minute or so. I'm going to see if I can get in touch with him.
Him.
Okay, perhaps then, John, if you're willing, we'll go to you, and then we'll see if we can pick back up with Dylan. Does that sound like a plan?
Yep, that's fine with me. So I'm just going to try and share my screen.
Okay, great. So while John's bringing that up, we began to hear from Dylan about how to treat free products within a satellite account framework. He referenced that a lot of decisions that are forthcoming are dependent on how we treat data in the accounts, and so we're very pleased that John is here to describe some of the current thinking around how to treat and measure data in the accounts. So, John, when you're ready, you can take it away.
Excuse me. So, Eric, are you able to just confirm that you can see it?
Yes, I can.
Excellent. So, as mentioned by Dylan, who sort of gave a slight introduction to my presentation, I'm going to speak about how we are looking at trying to include data as an asset within the next updated SNA. This work builds on a preliminary guidance note that was presented at the webinar last year. This preliminary guidance note generated agreement on several key issues. It proposed a definition, and it really it brought the discussion rather from being an if data should be included within the asset boundary to a how can data be included within the asset boundary, as there really was a general consensus that there should be some form of inclusion of data and the usefulness of data in the production process, and how can we incorporate that within the core accounts. In April, the OECD, so this is not just my work, but also the work of Peter van der Ven and Joris Weinenberg, we provided an issues paper to the digitalization task team, and then this was then presented to the AEG in April. And the paper covered quite a few areas, of which Dylan mentioned, regarding what costs should be included in a sum of cost approach to measurement of data, exactly how OPs may or may not be treated within the production and asset boundary, and as well as if there was any component of the data asset that should be considered non-produced. The focus for today's presentation will be what costs should be associated with the sum of cost approach. But I would recommend having a look at the paper. Similar to Dylan, we've constructed a numerical example where we show the different options that are available for how data may be treated in the accounts, depending on your choice of a sum of cost, a present value approach, a produced, a non-produced approach, etc. So quickly, just a recap on some of the discussions leading from last year to here. While there is no final recommendation on a preferred treatment of the measurement of data, there is a overriding principles that seem to be in agreement when this topic is discussed at various forums. And that is a preference for a prudent estimation methodology, one that does not dilute the usefulness of GDP and GSCF. It's also a preference that there be no extension to the production boundary, especially when it comes to the household sector, that the creation of information, going on social media, using free apps, that in itself is not production. And there seems to be general agreement on that. And so therefore, the production boundary should remain broadly where it is. But there also needs to be a preference for a practically feasible methodology. Otherwise, if it's too hard to implement, then countries just will not be able to do it, and we'll still be in the same situation where we are not able to show data within the capital stock. Now, the definition that was proposed last year has been slightly altered, but only slightly. And this is the current working definition for measurement, for data for measurement purposes. And that is that data is information content. And the important part here is that it's produced by accessing and observing phenomena. And then it's then recorded, organized, and stored the information elements from these phenomena. And this separation is very important when it comes to trying to decide exactly which costs to include. And I'll touch on that a little bit more in a minute. Just to separate, to make very clear that difference between phenomena and data. So everyone creates phenomena, people, economic units, nature. So the rainfall is a phenomena. What I do today is a phenomena. What the store down the road it sells today is phenomena. Now, these are, as mentioned, these are not considered production either now, and it is not proposed to include this as production in itself in the future. Now, what happens is that some units record information elements from these phenomena, and that is the construction of data. So once these information elements about these phenomena are recorded in a digital format, they become data. And so if we look at it from a sort of diagram point of view, we have the first large blue box. There is an uncountable number of observable phenomena occurring every day right around the world. But that does not mean that all of these are constructed into data. It is only those that are recorded that it then becomes data. Once this data is produced, it's then combined with other fixed assets such as database management systems, software, and it is therefore applied into the production of other goods and services. Now, because of the limited information on market valuation of data, trying to value data is very difficult. So sum of cost is seen as the most likely valuation method, and this is similar to what is already used in the national accounts for research and development and other intangible products. Now, there is some preliminary sum of cost work that already exists. I believe we'll hear some later today from Chris Blackburn, but also Canada has produced some estimates, and there are some other countries that have already done some preliminary work to put a value of data in the economy using a mixture of occupational wages from certain data-related occupations and other intermediate consumption. So that very basic sum of cost approach. But conceptually, what costs should be included. And to do this, to speak about this, I want to bring the definition up again, because as Dylan hinted at, we've separated the costs into two. And the first is the recording and processing costs. And that is the recording, organizing, storing, analyzing costs associated with the creation of data. And there appears general consensus that these should be considered as an act of production. The other costs involved is what we have labelled as the OP procurement costs. Now, currently, the SNA states to exclude these. So that quote is direct from the SNA that the databases should exclude the cost of acquiring or producing the data. In the previous guidance note presented last year, it was suggested that these costs should be included. So that should include the cost of collecting or acquiring observable phenomena. But really, what does acquire actually mean? If you are producing something that then provides you access, is that acquiring? Or if you are purchasing, is that acquiring? And that is certainly what this paper looks at, because firms certainly access observable phenomena in different ways, and it takes a large amount of different resources and production in order to get this. So we sort of identified three basic ways that firms are able to access observable phenomena, and that is in exchange for free services, which is associated with what Dylan is presenting upon, by explicitly purchasing them. Now, this may be the smallest group of how firms get access to OPs, but it certainly occurs, and there are certain examples of the supplying of purchase receipts in exchange for monetary payment. And that is, you are explicitly purchasing information elements of an observable phenomenon. And then probably the largest one is as a byproduct of primary production process. And I've got there the examples of retail, financial services, and logistics. And this is where in the standard production process, information is produced, which is then captured by the firm to create data, which can then be used to improve efficiency or increase revenue. And often these have minimal or no access costs because, as mentioned, they're a byproduct of the production process. But as mentioned, while the OPs, once they are collected, or the information elements about the OPs are collected, they may have different value. They may impact the value of the data in different ways. But you'll see that some OPs, the costs are non-existent because they are a byproduct of the conventional production. But this doesn't necessarily mean that the information elements they contain are less valuable than those that require a large amount of production or resources. And the example on the other side of the screen is the production of complex new digital platforms that provide free services. These require a large amount of research, labour, capital in order to create this free service that ultimately has been done in order to gain access to information about the users. And so the unit that is collecting the OPs and getting access to the OPs can do so from requiring a lot of work to requiring not much work. And then some can be as simple as a transaction in the case of explicitly purchasing them. Furthermore, the data platforms that are used to gain access to these OPs often have a secondary purpose. And so here we have the social media firms. Is the main point of a social media asset, the platform, the software, is it to produce data or is it to produce advertising? And so this is a further complication that it's not as simple as just assigning the cost of maintaining a social media platform as a cost of producing a data asset, as some of this is certainly being used as a platform to provide advertising. Finally, the final additional consideration to this work is that many of the costs, all the costs are already included in the accounts, but many of the costs are already captured in the estimation of other assets. So databases and software, the two assets that are already within the asset boundary of the S&A, will likely contain a large amount of expenses that are involved in these ongoing OP procurement costs. So is it possible to separate them? Should we separate them? Users would certainly say yes. They would like to know how much is data and how much is software and how much is database. But is this possible? Again, we come back to the idea of having a method that is practically feasible. Or is the better option, and one that was raised in the previous guidance note, to combine data and databases as a larger asset to a category than what is there now. So with all those additional considerations, it may well be more prudent to just say, okay, well, let's leave the OP procurement costs out, and the cost of valuing data will just be the recording, storing, and analysing costs. But if we do this, are we ignoring where the value really comes from, the value of the data that is being created now? So the quote I have cribbed that, so I should give credit to Victor Mayel Schomburger, who sort of talks about the fact that the access to capital is no longer the biggest problem for startup, it's access to data. And so if we consider that all units can record, analyse and organise the information, doesn't the real value added of the data asset, of the production, lie with the creative ways that firms are accessing new phenomena of which to record? And so, it may be my opinion, but I feel that these costs are likely to become more fundamental to the creation of the data asset, which would be certainly one argument for their inclusion. As mentioned, this is only one aspect of the conversation on putting data in as capital formation. There was some outstanding considerations in the previous guidance note, and in the last year, some additional ones have been added to this list, and this includes how data is sold once from the producer of the data to the consumer. As Dylan mentioned, the paper that we put forward in April discusses about whether or not there should be a non-produced component to the broader data asset to reflect the intrinsic value that comes from the OPs. We need some kind of confirmation about how the treatment of short-lived data that does not fit the asset boundary, how that is recorded in the accounts, as well as the explicit transaction in OPs. Are these a purchase of an asset, a rent payment, or is there another option that we should consider? So with that, I will stop sharing, Eric, and I'll pass it back to you.
Well, John, thanks very much. That was a very clear presentation on data, really focusing on costs and how to account or not on them in our work. So thanks for that presentation. I'd like to go back to Dylan. We have Dylan, and just to see whether Dylan would like to close out his presentation on free products. Dylan,
Yeah.
Share, you could just simply summarize. It seemed like you're close to the end.
Okay, I'm not sure at what point I dropped, so I do want to try to go back if we can to the slides because they might be helpful. So did we get to the baseline satellite account?
I think this is where we were. John, can I check in with you? Was this about where we were?
Yes, I confirm. This was the last slide that I saw. I think
Okay.
that Dylan was explaining.
Okay,
Thank you, John.
Let's go ahead and Let's go ahead and use this as a starting point for finishing up. Yeah, we're a little bit over halfway through. So what we've done here is split the value of the advertising services into the value for free products at 25 and the value of the advertising services at 250. And we're suggesting imputing the value of the free products using a sum of costs approach, and then recording those separately from the value of the advertising services, which could be calculated as a residual. So the highlighted cells are the bundled products that Jennifer and Marshall have identified and referred to in their draft guidance note. So we've also shown separate line items for the value of the free products that are embedded in the value of the final advertised product. Remember that value was 300, so we're showing now free products at 25 and the value of the final advertised product, the actual value at 275. So what we've suggested for sort of the simplest version of an SNA satellite account is to separate the value of the free products for the advertiser sector, which we saw in the previous slide, or exclude them entirely, as shown here in red, since those values reflect activity that takes place between the intermediary and the household. And then what we're left with is the production of free products by the intermediary and consumption by the household. Again, both shown here in red at 25. Likewise, the value of the advertised product now excludes any value of the free products that are consumed by the household, which are shown in yellow at 275. The balancing items are exactly the same as they are in the current SNA Central Framework. So we'll turn next to adding the value of the data asset. And I think we had not gotten to this slide previously. So here we're simply including the value of the recording and processing costs that John's referred to for data at a value of 15 in labor costs for the intermediary, which is then used as gross fixed capital formation. We've also added 1/10 of a place for decimals here as well, which will become obvious in a moment. The line items highlighted in red are the only new information added to the previous slide. So the only thing that we're adding to the baseline scenario. The balancing items change when we add a data asset. So GDP and other items increase by the 15, and those are shown in blue. We'll turn next to valuation and recording of the OP procurement costs that are based on the free products. In this case, we assume that half the value of the free products is used as intermediate consumption by the intermediary sector in the production of the data asset, and the other half is still final consumption by the household. And these amounts are shown in yellow at 12.5. The OP procurement costs are shown in red, and they add 12.5 to the value of the data asset because we're treating them as capital formation. Recall also that the actual amount paid by the household for the advertised product is 300, but the value of final consumption expenditure of the household has declined by 12.5 to the 287.5. That's now used, that 12.5 is now used as intermediate consumption by the intermediary sector. So we've imputed transfer of observable phenomena from the household to the intermediary, shown here in green, to account for the value displaced in final consumption. Note here in blue that output and intermediate consumption have both increased by the 12.5 for the intermediary, but value added does not change. It's still at 500 because the value added is already reflected in the value of the advertising services. Disposable income shifts from the household to the intermediary, and saving of the intermediary increases by 12.5 as a result of capital formation. So just to conclude, what do we accomplish with a satellite framework similar to the one we've proposed here? First is increased visibility of the household's role in the intersection of free products and data as an asset. We've shown some final consumption of free products by the household, but not all free products are final consumption as reflected under the current S&A treatment. We've also shown the imputed transfer of OPs as a use to make up for the loss in final consumption by the household. We've preserved the current S&A scope for the sum of cost measurement, and we've also avoided double counting output and value added in the production account, and thus also avoided double counting for aggregates in other accounts by disentangling the free products from both the advertising services and the advertised product. And then finally, we've focused on a single sum of costs measure for imputed free digital products, which reflects activity already recorded in the central S&A framework and mitigates significant imputed transactions for income and consumption. So thank you, and we welcome your feedback.
Dylan, well, thank you. And thanks also for coming back in after some of the technical difficulties. So I think what's quite nice here is you've helped bring forward, along with our colleagues at the ONS, this satellite account proposal, and having the numerical examples here really fleshes out how this would play out if we were to go this route. So quite helpful to see this full presentation, Dylan. Thanks very much. So let me just now thank all of our presenters so far for what they've put forward. And I'd like to turn to John for moderating what's come through the chat, as well as any questions that may also come forward. John, the floor is yours.
Thank you, Eric, and hello, everybody. And thank you again to the presenters for the great presentations today. Already we have some activity in the chat. I would like to ask others to introduce any comments or questions that they have there, so that we can pick them up. But so far, we have Lygia from Germany, who's been very prolific in the chat. And I can start off with some of her questions to the different presenters, just to start the process running. First of all, with respect to digital supply use tables, Lygia asks if there could be a quality measure, because some of the digital supply use tables will be based on real data, And some of the digital supply use tables will be based on assumptions, the rule of three she mentions. So is there some kind of quality measure about the balance between the different cells? How many of the cells are real data and how many of them are based on these assumptions? That's our first question. I wonder, Eric, if you'd like to see if Ziad would like to comment, or anybody would like to comment in the chat on that. We'll try to pick that up, unless you want to answer it yourself. Okay, well, let's wait a second and see if something comes through in the chat from Ziad or others on that point, and then let's start to pick
John,
some.
If I could possibly add a little bit on that.
Please, John, go ahead.
If needed, but whether or not we want to wait for Ziad. But certainly, when we were talking about the development of the digital SUTs, I think in one of Ziad's slides, he had a saying which I really liked, which was allocation, compilation. And I think that that's a really good point. And it is a fundamental strength of the digital SUTs is that we are starting with real data, so to speak. Certainly that idea of a quality assessment based on the numbers in this cell are actually based on an indicator versus the numbers on the other cell is a residually derived one, I think is certainly something that we would look to do once we have a greater examples of the digital supply use tables coming out. That idea that we can have an estimate created residually, as mentioned, is one of the benefits of starting with the digital SUT. So I think it is a missed opportunity if we don't use that. But at the same time, it is certainly a good idea to try and put some form of quality guidance on each of the cells as they're populated. I think that's a good idea.
Thank you, John. Eric, you wanted to come in?
Yeah, thank you, John. And I'll also acknowledge it's a very nice, helpful comment. And I agree with what John Mitchell has just said, too. So the way that we think about it in the US as we prepared our initial estimates for digital supply use tables and high priority indicators is we recognize that there are probably more assumptions taking place here for some of the activity that is hidden or not well captured within existing surveys or administrative data. And we focus on being as transparent as we can about that methodology. I mean, we recognize that the collection apparatus, the classifications may have to catch up where we currently are, and we don't want progress to be stalled simply because we don't have the preferred data sets yet. And this balancing act, I think all countries are trying to do this balancing act right now around bringing better visibility by compiling these accounts, even if we recognize they are indeed not our core accounts, they're satellite accounts. And so we have room to experiment and be transparent about those methods. And then I guess is able to come in later through the chat on this. Thanks, John.
Thank you, Eric. So moving on to the free services, free products, and Dylan's presentation, there were 2 points I've picked up from the chat. The first one is a question from Lygia again, which is, will there be elaboration of bridge tables from the satellite accounts for free products, free services? Because her point is that if you have these bridge tables, you can see what do you have to add in or take away from the core accounts if you want to get the overall picture. So I think she's asking if a bridge table type approach will be developed as part of that. And then I see Sanjeev from the UK has thrown a bomb into the discussion by asking about final consumption of corporations. Should we actually start to record final consumption of corporations because of the intermediate costs involved in delivering those free services? So there's 2 for Dylan, I think, now.
Okay, thanks, John. So yeah, in response to Sanjeev's question, I think we've left a lot out currently of this. We wanted to start simple from where we are currently in the SNA treatment, and then sort of build from there. So we've left business use of free products out. It could be, I think, either intermediate or final. I'm sorry, we've left the final consumption out and included only the intermediate portion. And likewise, we could add in there intermediate consumption of free products by households, which we've also left out and just left a portion for final consumption. We would have to have a reason, I guess, that we would want to treat the free products or the use of free products as final consumption by business. So for now, we've just gone ahead and shown the intermediate consumption. As far as bridge tables, I guess, yeah, that sounds like something that might be worthwhile. As we've have it currently in its very simple state, it's, I think, pretty easy to see where the free products come in and where the changes are taking place. But as we become more elaborate and sort of deviate from current SNA treatment and current conventions in the SNA, then we're going to probably want to be a little bit more explicit about where some of those deviations come in and what the consequences are. Thanks, John.
Thank you very much, Dylan. So, in fact, that's extremely good to move on then to John's presentation on the OP and data, and this has actually brought several comments into the chat. Lygia has also been active on this. I picked up two comments from her. The first one, I believe, is just a sort of terminology point, which is you mentioned that the OP could be a building. In fact, I guess what you're thinking about is an address or a geolocation, and the building itself is an asset in our system. I think it's important to clarify this. And Lygia's other question is what do we do if we want to add an operating surplus to the sum of costs? So we derive the value of data from sum of costs. Do we add an operating surplus? How do we interpret that operating surplus and put it somewhere in the box of the national accounts? We also have a comment from Christopher from the United States, Christopher Blackburn. And his concern is that with the definition of that we currently have, that somehow observable phenomena are the same thing as data, so that you actually risk introducing an intermediate or analytical step between having observable phenomena, something called data, and then moving towards data as an asset. So I think his concern is this kind of processing of the observable phenomena. When do you call them data, and when do you call them a data asset? What's the boundary? I think this was Christopher's point. And finally, in the chat, Marshall has come in and is asking, will the value of the new data assets on the balance sheet include both the costs of generating the data and a non-produced component arising from other changes in volume or holding gains? So if there is a change in valuation during the process, maybe caused by the value of the observable phenomena, will that be included? Please, that's all for you, John.
Sorry, hit the wrong button. Thank you very much, Mr. Verinder. I will try and cover all of them. Certainly, I think John half answered one regarding the terminology. This might be my casual presentation style, but yes, John is certainly right that the building itself is obviously a produced asset. In the definition, we used information elements. There is a lot of terminology that is still being developed to find one that is understood broadly. And so the information element about a building, as John said, the address, how many people work there, the color of it, who knows? OPs can be the result of an entirely naturally occurring event, such as rainfall, or it can be the result, an externality of a production, whether or not it's building a building or the amount of retail sales in one shop. That itself is production and value add. The information element about how many retail sales occurred that would be an OP, which we are hoping to collect. So hopefully that clarifies it a little bit. But as I said, certainly we are still developing the exact terminology that we want to go with. Regarding the operating surplus, in the paper that we put forward, we did raise the idea of possibly valuing data using a net present value approach, which would somewhat contain a markup or a return on investment. Broadly, this seems to be the less preferred option, and I think this is mainly from a practical compilation that it certainly would be considerably harder for statistical officers to introduce. Now that said, personally, I'm not against the idea of adding some form of markup on a sum of cost approach. I believe, Ziad might need to correct me, I believe that when Canada released their valuation, their estimates of data in 2019, I believe they included a small markup as a return on investment. Now, what that should be, I would have no idea, but I think that is a reasonable consideration, that if firms are to apply capital to constructing an asset, they would expect some return on that. And I think that's something that we will need to continue to discuss as this gets tested. Excellent, thank you, Brenda. Yes, she's just confirmed that Canada did include a markup. So this is something that we just need to explore as more countries do tests and come up with experimental estimates. I believe next was Chris regarding the data becoming data or data. When does data become a data asset? And certainly that conversation about when does an OP become data was one that was had over the last year. I think in the paper we are broadly suggesting that all data, all recorded OPs is data, and theoretically it is an asset. Now, some may be worth very, very, very little if it has absolutely no point and is not analysed. Some data may be extremely valuable, and it may become more valuable as it is analysed, but it doesn't necessarily change the fundamental asset, which is the recorded and digitised OPs. And I suppose a very crude similarity would be that if you bought two cars, but you only drove one, it doesn't make the first car any less of an asset, even though it is not getting used. Whereas the second car that is getting used all the time doesn't make it, theoretically, doesn't make the car itself any more valuable. And so I know that's not a perfect metaphor, but I think broadly speaking, we would need to say all data is an asset or no data is an asset. And if we're going with the first one, then it becomes a valuation discussion. And the final question, I think, was about Marshall. John, that's right, Marshall, thank you. Regarding non-produced and produced. In the paper, we certainly discuss with a bit more detail than I did today about some of the reasons why we may want to consider having a non-produced component into the overall data asset. I think, again, this will probably become back down to a practical discussion as countries begin to try and implement estimates of data in the economy, trying to show which is the result of production and which is due to the value of the OPs that they are capturing. While conceptually, I feel there is a very good argument for it, when it's practically implemented, it may prove beyond statistical officers to give reliable estimates in that. Now, that's not to say that we should not try. If we feel that there is good arguments for having a non-produced component, then I would encourage countries to look at the paper and get involved in the discussion and perhaps try and introduce this into their experimental estimates, because similar to a markup, it's really going to be found out as countries approach this, rather than saying yes or no straight away. It really should be seen as what is possible.
Thank you very much, John. Circling back, Ziad has kindly put a comment in the chat on the quality indicators, absolutely agreeing with the comments made so far, and in saying that transparency in methods and quality are critical for proper interpretability and addressing possible weaknesses. So Ziad totally confirms what's been discussed already. Also, coming back to Dylan, but it's not a question. Sanjeev is simply saying that he'll be happy to discuss, and particularly if there's a potential impact on generating a different GDP. But I don't suggest we go there today. As John said, Brenda from Canada confirmed that there was a markup added to data in their estimates, the same as for own account software. And Peter van der Ven adds that a markup would be a logical choice because sum of costs is just a means to arriving at a market equivalent price. However, we do come back to John Mitchell because Sanjeev has asked two questions. One is, what about life lengths of, I guess, data assets? And secondly, what about prices for deflating data assets? John Mitchell, are there any thoughts on these two questions?
It's a tricky issue. I'll try to elaborate a little. Broadly, the deflation issues is similar to other non-market or own account sum of costs asset in the fact that what we're really the largest argument or the largest complaint from users regarding an absence of data is its impact on productivity. And so if we were to simply go to deflating the sum of costs, then this may not necessarily solve that problem. So while I know Canada, when they produced their estimates, used price indexes to deflate their current price estimates to arrive at a volume, I don't think it's as simple as just saying, let's do that. So unfortunately, I don't have any new revelations on the discussion. Right now, we're still firmly focused on current price, but obviously volumes will need to be addressed and deflating. Regarding the life lengths, I think that this is perhaps more of a discussion on the output side, if I sort of make sense. That most of the discussion has been valuing the data asset constructed by the data compiler. We haven't had a lot of discussion on how it is then sold. So whether or not it is sold as a service or a license, or just as an asset even. And so I think when we have that discussion on how it is sold, that will probably involve a little bit more about data length of life, because the data compiler is likely to hang on to it for a year. It's that who they sell it to is who is likely to lose it for less than a year. Now, that's not always the case. So, Said, you don't write back and say, oh, this example, because I appreciate that is not always the case. But I think it certainly fits into that idea of needing to look at it from both the cost of compiling it and then how it is sold. So I think I'll probably leave it there.
Great attempt, John, at that, I think. Just before I pick out a couple more points in the chat, just to encourage everybody, we have a bit more time now, so please do come in with your points in the chat. Just to raise two issues, both on data. Ligia from Germany points out that the economic life of data depends on what kind of asset we're talking about. So she rightly points out that perhaps a single file might have a short life, whereas a data set which you update regularly and keep running will have a much longer life. And I guess she's perfectly right, but you may want to comment on that, John Mitchell. And also, Christopher Blackburn from the US asks, thanks for the answer, has a fear about these definitions of data and the impact with measurement, in particular, the relationship between phenomena and data. So perhaps I can think of a good example. I record a video on my smartphone of me doing something, and it's just on my smartphone, so nobody else can see it. Hopefully, it's just mine. But then I upload it to Facebook. And once it gets uploaded to Facebook, it's still the same video. It's just sitting on a platform instead. At what point is that video an observable phenomena or data? When I upload it, when I record it? Perhaps I'll throw that tricky question to you now, John.
I think this is where we probably will come into, is it used in production? Are you using your video in production, John? Because if not, then maybe we don't need to go down that path. So the idea, isn't digitized phenomena still phenomena? I could answer by saying, isn't non-digital data still data? And the answer is yes. However, we've made a decision to only focus on digitized phenomena as data, because it would be impossible to try and measure all the non-digitized data, but in the use of production, I'm sure there is some non-digitized data that is used in production, but the vast majority of data used in production is digitized. So I think this comes back to the idea of, is the data asset being used in production? And if it is, then we will look to value it. If the data is not being used in production, then all sectors will have data. And I think that's where we need to try, and I don't think we're there yet, is to try and come up with some form of guidelines about what data we really want to value and which we don't. So again, I think that's the best I can probably do at this point, John, for that particular issue. Regarding the idea of costs of updating a data set, having value, I think again this comes down to trying to crystallize our final definition. Is each new data set a brand new piece of data, or is it the extension of existing data? And I don't think we have an answer for that yet. I think that will come down to a valuation approach, because once we have a new data point that adds to a data set, does that therefore make the old one useless and no longer used in production because we have this new one? So again, a really good question, and one that has been discussed. Unfortunately, we don't have an answer for it. I would lean more towards the fact that it's the data set that we are really valuing, rather than the single piece of data. But as I mentioned, there's still relatively easy still to poke holes in that. But this is the point of these discussions, is to try and continue to bring that forward.
I think in a previous meeting we discussed the difference between my email address and Joe Biden's email address in terms of value. So let's not perhaps pursue that too far. So you've partly addressed a comment from Lygia in the chat about the costs of updating databases, and I think that's an important point. Because if you don't update a database and it becomes out of date, then it becomes much less useful, and therefore there's a borderline between updating as fixed capital formation, because you are maintaining the whole value of that data asset, and these incremental maintenance points, which might not be capital. There is, however, a point from Jennifer, which is worth considering, which is if you're combining data, database, and software, you could actually consider just taking the service life of software. However, as Jennifer rightly points out, the software service life may be too short in that context, because the data may live longer than that. So would you like to just comment briefly on that before I go to Dylan and give you a rest, John?
Only, and this is very much my own personal opinion, that when we are trying to come up with the idea of asset lives, or the service life, that we do need to remember that most countries are using some form of PIM, that the PIM contains a large amount of assumptions, and not every building lasts 80 years, but some last 200 and some last 1 year, and that we are really looking for that average. And what data may actually be is just have a larger extreme of some data that lasts 1 day and some data that lasts years and 100 years. Now, that doesn't mean that we need to have a service life for every single one of them. We make assumptions with other assets to try and arrive at some form of average, and we will need to do the same with data. And some of those assumptions may be a little bit more uncomfortable, but I feel like that the fundamental methodology is still sound, and I think that for defendability, comparing it with something like software is not a bad starting point. And And as I mentioned, a lot of this will come out in the testing. When we start to apply various assumptions and we get the results, then we need to unpick exactly if those assumptions are causing some form of externality that we weren't expecting. Thanks.
John. So the last one in the chat is a fast ball from Marshall to Dylan on this issue of final consumption of corporations, and indeed whether we have a potential problem with double counting, because are free products part of the cost of producing advertising services? I mean, I think, Dylan, you said earlier that the whole account's not yet elaborated, the whole satellite account, and you need to pick into this. But Marshall just asks, is that perspective going to be considered in the guidance note?
Yeah, I mean, so this is really going back to Sanjeev's earlier point, and we have considered a number of options that would impact GDP, but the key would be to reconcile those options with the current SNA treatment, because they generally require changes to the current scope of the SNA and definitions and different conventions. And we would need to be able to discern whether there's double counting if GDP is changing, and whether we would want that double counting if we can justify it. And so we've talked about this a bit as a group, and I think as far as the initial introduction to the SNA community, we need to start simply, and then build from there. So.
Thank you, Diane. Well, that's it. It seems in terms of the chat and comments, Eric. So over to you, please.
Okay, great. Well, thank you, John, for moderating this session of questions and comments from our colleagues. I'd like to thank Dylan and John for their excellent presentations during the first part of this session on digitalization today, as well as Ziad for preparing a really informative presentation on the Canadian experience in developing digital supply use tables and high priority indicators. And I got to admit, this really struck me as robust. It's challenging to these virtual back and forths around topics. Nice on data in particular. And John Mitchell, you're on the hot seat quite a bit. It makes sense. Data is really something that's on the forefront of all of our minds. Let's flesh that out in a little bit more detail this morning than we've been able to in large group settings. So thank you for that. We're at coffee right now, and so it's 14:27 time. It's for us in the US, it's 8:20. One of the things we deal with these virtual meetings in this new environment. So let's take a bit more than 15 minutes. Come back at 14:45, and we'll get started promptly then. All right. See you all shortly. Thank you.